Hello, today is Saturday, March 11th. My name is Brent Kachuba, and this is Silicon Valley Bank weekend. Unfortunately, we have a lot of folks in the tech and finance spaces waiting to see what's going to happen with the failed bank on Monday. And while we are not here to talk about the risks of the bank and the contagion, we are here to look at the options market and how it prices or adjusted for risk around the events of the last few days. And so, with that, we are going to jump in. The first thing is this summary for those of you with shorter attention spans. Number one is tail risk has repriced. It is repricing higher, obviously, as a result of all the effects. This is not necessarily a demand thing, but may just be a volatility thing, as we will talk about. There is, however, very heavy VIX call demand, and that is something that has not occurred just this past week, but it's been a theme of the last several weeks. And we are seeing lighter SPX tail demand, so not a whole lot of downside demand for puts. There's very heavy day trading activity, I'll call it, in puts in general, and some signs that is also occurring in equities. Again, where the positioning, sort of the bets or actual open interest is lighter. And to the same point, the focus of a lot of the action is in the KRE and the regional banks more so than the mega cap banks. And also S&P. So the risks at the moment seem kind of idiosyncratic or focused on the regional banks. And then lastly, while we are all looking at SVB and what may happen this upcoming week, we cannot shy away from the fact that there's the CPI on Tuesday. There's a very large quarterly expiration on Friday, and that plays right into the FOMC. So there are a lot of catalysts in general outside of just the bank. Number one, we're going to start with the official data. This is from the OCC, the Options Clearing Corp. Each week, they tell us what the week-over-week change was in call and put positions, specifically how much premium or contracts are traded. And what you'll note here is there indeed was an increase in puts bought in the index space, so think SPX index options, but it is not record Lehman style or March of 2020 style level put purchases. On the right here, we have contracts. There are a lot of contracts being traded, but again, from a premium perspective, when you think longer dated options, they cost a little bit more. They cost more in premium. There's not so much of that. Same thing on the equity space, which is on the bottom here on the left. For those of you who've been following us for a while, you know there was a structural kind of arbitrage trade taking place over the last several weeks, which is why you see such a surge in equity put positions. This is not sort of speculative put buying, so kind of ignore this. What you see in the equity space is a little bit of bump for equity call premiums, but not, equity put premiums, but not again, a massive record high surge. What about zero DTE? One of the themes over the last several weeks is, hey, the VIX is dead because of zero DTE. And we're sort of against that view. And it's for an event just like this. In fact, the zero DTE volume on Friday was quite light. This is the final little bar you can see on your screen here. And one of the things that we talked about on our Thursday morning note was this theme of zero DTE suppressing intraday volatility. And at some point, that would likely get washed over or blown out by kind of longer option demand, tail risk, kind of Vega, kind of running over those shorter dated options. And we thought that it would be a credit market action that would spark this change. Now, we had no idea that would actually happen the very next day with Silicon Valley Bank. And it's not even clear at this moment that this theme will continue of VIX and tail demand. The bank could get bailed out on Monday and we could rally. Who's to say, right? But it is generally credit events that drive oftentimes the demand for tail risk. And so that is a key point. Again, we talked about this on our Thursday morning note. Moving forward, you can see that the VIX index obviously spiked relative to historical standards. It's a good jump. And, things are stirring right now, right? But we're not completely freaked out at the moment. And this is sort of a theme that you will see throughout this presentation, that there is certainly the element of risk, as there should be, but not panic. If you look at the VVIX prices essentially skew in the VIX, or what is out of the money call demand in the VIX. You could think of it that way. And it has jumped materially higher. One of the themes of 2022 in general was puts underperformed. There wasn't a big vol spike despite the grind down in markets. And now we've had this jump lower in markets, or jump higher in vol, I should say. Tail risk is now present. And again, once this sort of starts to wake up, it is one of those moments where you can see it really shift materially higher now that there's a bit of positioning in the market. What about implied volatility? So this is the 80% IV. So if you look at the money option and you look 20% down, what is the implied volatility of that? So this is a 3-month 80% implied volatility reading. And what you can see is, again, that tail risk now is getting a price. It's catching a bid. It was quite a jump, and this is the element of the start of risk. But if we do get a bailout on Monday, this major spike, obviously, in volatility may be delayed some or pushed back or snuffed out. The term structure, again, obviously elevated. We're in backwardation now. Backwardation is a sign of fear and risks in the market. You notice that there's two nodes here. One is implied volatility is extra high for this event vol around the CPI on Tuesday, and then 322 FOMC. So we've gone from this sort of flat contango, not particularly concerned market to, hey, now there's some risks we all need to look at as we head into, again, this tumultuous weekend. Same thing with skew. Skew obviously pricing higher. There is that demand for some tail protection. So what were some of the relationships of the moves on Friday? This jump in skew was one of the things that was most interesting and kind of one of the bigger aberrations, I suppose. I want to give a hat tip to Alpha X, the great Twitter account. They first flagged this, the fact that VVIX had a huge jump relative to the move in SPY. So normally you'd expect, yes, as the spiders go down, you'd expect the VIX to go up and VVIX to move up a little bit, but this was an outsized jump for VVIX relative to the move in spiders. So again, we went from having no tail risk price demand, really prices were just kind of dead for out of the money puts and out of the money calls in the VIX, and now we're getting kind of a repricing of that. Same thing if you look at the VIX versus the VVIX, you can see again, you would expect the VVIX to go up when the VIX goes up, but this was an outsized move for VVIX that skew again is picking up. Same thing in the equity space. This is spiders versus the SDEX, which is a skew index for the S&P 500. Bigger move in the SDEX than we would expect in general relative to a move in spiders. So let's turn to the financials where the real action is. And first, obviously, the KRE, which is the Regional Bank Index. Obviously, a huge jump in implied volatility there. And relative to historical standards, this is a big one. And it's likely, obviously, because there was only about 2 bank failures, I believe, since October or so, or March of 2020. So banks have been relatively stable, but this has led to a very large jump in implied volatility in that ETF, as one would expect. If you look at the drawdown in the banking ETF, it's a huge drop, obviously, and that also goes with that SVB essentially going out of business. And so it would make sense that index would have a really sharp drawdown, but that drawdown there is shades of March of 2020, I would say. The other thing I want to note here, while we primarily focus on options coverage, there's just a massive volume spike in the KRE index. And this is something we saw with puts as well. Huge put volumes, a good, decent little chunk of gain in open interest, but clearly there's a lot of just day trading type activity going on. And I think when you think about a run on a bank, right, where people are suddenly pulling their deposits, and you listen to the stories of Silicon Valley Bank, and there's kind of like Slack chats of, hey, we all got to get our money out. This idea that like just volume coming in to pressure the bank lower is kind of what you feel like, right? When you get puts coming in, very short dated puts, heavy, very short dated volume coming in, that doesn't strike us as actual positioning necessarily, and in some of the cases, at least in puts. So this spike in volume, especially so much higher than anything we've seen in history, is really noticeable. And if you look at spiders, yes, there was a spike in volume, as you can see here, but it's not not a record, certainly not what we saw in March of 2020. So these two things don't really seem to line up quite so well. Again, in this idea that I think people were preying a little bit on the action. Overall, this is just a measure of total exchange volume in New York. Now, these are quarterly expirations, I believe, so there's always a little bit of noise in this data. But good spike here in the NYSE full tape New York Stock Exchange total stock volume. But again, relative to historical crises, it's in the realm there, right? But not quite at that same standard. Lastly, what we have here is what did the XLF do to versus the spiders? It's totally in line. So the move that you got in XLF, which is the mega cap financial system, the JP Morgans, the Goldmans of the world, very in line with what you'd see on a drawdown in the spiders. And in the KRE, it was a little bit higher, I suppose, of a move in KRE relative to the spiders, but fairly in line, interestingly enough. Certainly not the same thing as how much skew repriced. So let's look at the actual options volume in the KRE. Humongous put volume, rivals that of March of 2020. Good spike in calls as well. But again, in this case, when you look at open interest, yes, big pop in open interest, as you'd see. So clearly people positioned for more downside or wanted hedges in the KRE. It makes total sense given the environment. So where specifically did that open interest pick up? On the bottom is where we want to focus. If you look at the change in open interest from this is Monday to Friday, you can see that is really concentrated in the April expiration, a little bit in June, and for the most part in the 45 to 55 area. Again, KRE closed around 50, I believe, on Friday. And so, there's that kind of open interest where it's positioning a couple of months out here, or a couple of weeks out, I should say, and fairly rich in terms of the open interest gain. Not massive, I would say. If you look at where all of the open interest is, so this was the change in open interest. If you just look at where all the open interest typically sits, obviously the flag you want to see here is for next Friday's expiration. There's a good bit of open interest. It's going to probably gain a bunch of value here or lose a bunch of value depending on what happens over this with the bailout on Monday or no bailout. But again, April and June expirations are pretty big. There's really no interest, open interest under that 50. It really starts to dry up, as you can see, which suggests that traders aren't pricing in a whole lot more downside at this time for KRE. What about the bigger financial sector writ large on here is the XLF, certainly a big drawdown. Same thing with JP Morgan, and JP Morgan is kind of considered the gold standard of banks at the moment, as a good measure of gold standards for banks. Big volumes again, big drawdown, but not kind of cataclysmic stuff. If you look at the open interest position in the XLF, we have big put volumes again here on the bottom, but open interest, yes, it was up, but not record material, right? So if you thought that the financial system, this was Lehman 2.0, you would probably be piling more into these XLF options or looking for some more downside protection there, material hedges that you would hold, right? Didn't really seem to manifest here in XLF. And not only that, on 317 expiration, a lot of this is going to expire. So very interesting. Again, huge volumes. And yes, there's a pop in open interest, but not kind of cataclysmic stuff in our opinion. You look at the change in open interest for XLF, same thing. A lot of activity out in April. And nothing really seems to happen, or not a whole lot seems to happen below the 30 strike in terms of new put positions that were purchased. And then same thing here in the put open interest. You can see June is a big expiration, which makes sense. This is the quarterly, but that put open interest kind of dries up under the 30 strike, which is a decent, obviously 10-15% lower, which is a lot in the XLF ETF. But again, it doesn't get this idea that there's Armageddon style positioning in this case. Lastly, humongous put volume in JP Morgan. I think it was the record. It certainly looks like a record, at least pre-COVID record. And open interest, it was up a little bit, but not shocking levels of open interest. So the theme here, y'all are probably picking up on it, is in the regional banks. People are looking for the spread or concerns in that sector specifically, but not an overall theme of, hey, larger financial concerns, or even, as we're going to talk about in a minute here, larger put positions in the S&P 500. So we get the distinct feeling that the tail risk now has a bid, but that didn't necessarily mean that there was demand for that tail risk protection necessarily. So let's talk about the VIX, where there is clear tail risk prices coming in. Huge call volume, near record call volumes in the VIX. Again, this was not something that necessarily just popped its head out yesterday, or on Friday, it did really start to grow on Friday, certainly. But over the last several weeks, we've seen an increase in call volume and call open interest. So traders, were positioning or starting to position for something like this. Whether or not it was SVB specifically, I mean, who knows, right? But clearly there's been this demand from, famed traders like 50 Cent and the like, looking for VIX protection. And in this case, this is VIX call open interest, record VIX call open interest. So this is real tail risk. This represents convexity in the market in Vega, right? If the VIX starts to wake up and starts to move higher, these VIX calls start to gain in value, gain in size. And then again, like we talked about at the start, yes, 0DT is this focus, but suddenly when you get to these VIX calls catching a big bid and Vega starting to pick up in the market, and you get this idea of convexity and jump risk, suddenly that focus on 0DT is probably going to move away pretty quickly. As far as how did the VIX contracts change over the last week, obviously just big call additions at the 30 strike. There is an expiration of the VIX on the 22nd. And then so obviously when you look forward from that, you can see that in April and May, there's some new contracts that were added. These are some pretty material contracts in size, again, gaining to that record call open interest. And then when you look at the full open interest, not just the change as we were just looking at, clearly a lot of contracts are set to roll off with March expiration, and then you'll see that 30 and 40 and then around 50, those kind of even handle strikes. There are some fairly large VIX call positions, and so if we start to get up into VIX 25 to 30, these calls could really start to gain, or sizable levels of these VIX calls could start to gain, and that could represent some convexity that dealers start to worry about. Lastly, in this section, we're going to look at the S&P 500. Record put volume in the S&P 500. Really very shocking levels of volume. But open interest, very mild. Yes, an increase, right? But when you look at record volume, 2.5 to 3 million contracts just in puts traded, that's huge. And yes, put volumes, put open interest was up, but not this equivalent spike, right? And this speaks back to this idea of day trading and flipping in and out of positions and momentum trading. And if you thought that the world was going to come to an end, you were worried about Lehman 2.0, you would think a lot more of this volume would translate into open interest, but we just didn't see it. The call changes are fairly mild. Hardly any call changes on the put side. Yes, there are each of these little red dots indicate a change in open interest, net change in open interest over the week. And, there's a little bit here of downside. It appears there's a pickup in some tail risk for about a year out in time, 6 to 8 months out in time. Some activity down at, strikes that are 20, 30% out of the money. And it's fairly light, right? It's not, massive gains in open interest on the put side. So the total put positions, when you look at that, you can see how many put positions are at 317. That's the big one. But also note this quarterly expiration 331. There's a fair amount of open interest there as well. And you can see how there's these concentrated sort of ticks of positions of these deep out of the money put positions, which is a little bit interesting here. But that key takeaway again is that yes, there's some activity, but not something that necessarily suggested that the overall market was positioning for Armageddon. When you look at the spiders, the more retail product, you see a little more at the money activity here, probably a little more speculation as opposed to hedging or positioning for downside risks. One of the interesting things to look at is the volume that took place again in spiders, concentrated in closer dates, right? This is 0DT expirations, 317 expiration, caught a lot of that volume. But spiders, again, seems to be a little bit more at the money, which is the retail product. One kind of extra credit chart that we found was interesting is huge put volume in ARK. ARK's names come up a little bit related to the Silicon Valley, tech space and having money at SVB. None that we're necessarily sure of, but quite fascinating that there's just massive put open interest in ARK. And again, huge volume in that ETF, something just that caught our eye. So what are the risks moving forward? Number one, we keep talking about this March options expiration. This is the delta across these major index products. And you can see that the put delta, which is here on the bottom bar, is very large. This is, again, a quarterly expiration, so there's a lot of size here. And the risk is, particularly if we're below 3,900 in the S&P, that as we move lower, these puts gain in value and dealers have to continue to short futures or short stock to maintain their hedges there, and that can lead to larger, faster drawdowns in the market. So this is essentially another way of saying expect more volatility for below 3,900. To the upside, if we move above 3,900, the decay of all of these put positions could pick up pretty quickly, and we think that the market would then pin for this week into the 4,000 to kind of 4,100 area, basically just mean reverting to where we were earlier last week. But if you're worried about kind of like a convex downside move, the possibility of that really picks up under 3,900 specifically. But again, if the bank is Silicon Valley is kind of, there's a bailout and an orchestrated bailout and the contagion risk seems to be called off, we will get obviously a pretty quick pop in the market. And I think that would really destroy these put values. But that momentum would really die off over the 4,000 strike. When you talk about the quarterly expirations, we've been talking about this for years. You can see we just highlighted a couple of larger ones on your screen here. The most famous two being March of 2020 and then December 2018 when Mnuchin was calling around to the various banks to say, hey, do you guys have liquidity? Are you guys all okay? The low of that market, that debacle in 2018, was the Monday after the huge December options expiration. So you can look forward in time and see how often that the lows coincide. So one of the nice things I think, and not that there's ever nice about a sharp drawdown in the S&P, but if we do get a really big move lower this week, there is the big March options expiration, which could offer a catalyst for recovery. So in some ways, it sets up what we think is a clean setup. If we draw down into Friday rather sharply, we clear out a whole bunch of put positions, which also moves into the FOMC for a possible rally. So when you look at the play out or how these dates play out, again, the CPI here, which is something that you want to catch an eye of or keep an eye out for. We play into March OPEX and then FOMC. So kind of the cleanest setup that comes out of this in our view is a drawdown into March OPEX. Those puts all get cleared out. We also have the release around the FOMC kind of event vol. The Fed may kind of back off of things a little bit now. Some are saying because of this bank risk, did the Fed actually break something this time? Those kinds of messages are passing around now. And so, we could have a window for a decent rally here if we do draw down. Now, if we don't draw down and we end up in the 4,000 to 4,100 area into March OPEX, then there's a lot less reason for the market to rally off of that fuel. And so that's why this sort of path dependency in the options expiration itself is important. We closed, one of the other things to note here, we closed below our put wall on Friday. We generally believe that when the market, risks aside, if we're just looking at the sort of technical setup or the positional analysis around this, what we find is generally the market behaves pretty well after closing below the put wall. So if you look at our stats here, essentially what you see is there's a very wide distribution of prices around the put wall, meaning that there's a big tail here to the left and a big tail to the right, 5 days ahead. But in this case, there is a skew to a positive market 5 days and even 1 day after closing below that put wall. Now, in this case, it is kind of a binary outcome based on what happens with Silicon Valley Bank. But in general, when we pull down this low this fast and put positions don't roll lower, which is key. If put positions come in and roll lower, which, at this point is not clear based on how we're talking about fairly low put demand. But, if we get heavy put demand, this put wall rolls lower, tells us that the market's open to lower prices. If we come in on Monday and find out that, hey, the put wall was stable at 3,900, then oftentimes that is a signal that we're due to bounce, as all of these puts at 3,900, if the market stops going down, they start to lose value rather quickly. Implied vol comes down. This is the whole Vanna component, and the market starts to work its way higher as those puts lose value. So those are the options positioning. Our view of options positioning around the SVB debacle this weekend. If you do have any questions on this, please send us a message at info@spotgamma.com. You can hit us up at SpotGamma on Twitter, and we just want to highlight back to our key points here at the top that, again, the elements that are in play here are tail risk has certainly repriced as not necessarily, at least in the S&P, a function of that same demand, but there is very heavy call open interest, and that call open interest has been around for a while. So we didn't see a tick up in macro risk positioning necessarily is what our real key takeaway. And also just a lot of very short dated volume, which just sort of looked like more speculative activity coming in. So from our perspective, we don't think that the market was really looking at this kind of contagion, Lehman 2.0 moment. Certainly the regional banks have some obvious risks. And, lastly, we just want to make sure that you understand this is an interpretation of options position and is not investment advice. So make sure to keep that in mind. Again, any questions, please send them over to info@spotgamma.com or hit us up at SpotGamma on Twitter. Thanks.